In this video, I wanted to show you what are my most profitable stocks, because when I trade options, there are some stocks where I tend to make a lot more money compared to some other stocks using the same strategies. So I thought it would be interesting maybe to show you what are my most profitable stocks and also why they have been my most profitable stocks, because there are some reasons behind it that I wanted to share in this video. We're going to talk about stuff like implied volatility percentile. So if you have any question throughout the video, just don't hesitate to comment it below. I'll be happy to answer any question that you might have. Because what I used to face before is that I would trade options and I wouldn't see that there would be some stocks that would be a lot more profitable compared to some others. And I was trading options on some stocks that were basically not making me a lot of money compared to some others. And when I think back about it, if I had focused my attention and my capital and I had only traded options on those very profitable stocks, I would have probably got a lot better results. That's why I wanted to break down this a bit to you and show you what are my most profitable stocks and show you the reasons behind why they are so profitable, because I think it can really help you in your trading, especially if you like to sell options like I do. But before we dive into the video, if you find this interesting and it actually brings you some value, then don't hesitate to like this video and subscribe to my channel. That's really the best support you can give me, and after that in my analytics, it helps me know which type of videos you like to watch more than others. So first of all, we're going to look at the list of my most profitable stocks. I'm going to show you which stocks they are so you can also have the tickers for yourself, and I'm going to after that explain why they are so profitable and what you need to pay attention to if you also want to spot some good stocks. So let's jump into my trading platform so I can show you that. So now we are in the TestyWorks platform, and what you have in front of you is a watch list, and basically the watch list of my most profitable stocks. So basically what I've been doing is that I looked in my P&L at the stocks that brought me basically the most money, and I compiled them within the list, and here they are. So basically I have 6 stocks that are very profitable for me. First there is Freeport-McMoRan, then there is United States Steel Corporation, then there is Dropbox, Gap, Alcoa, and Cleveland-Cliffs. So those are 6 stocks that basically have brought me a lot more money compared to others. But what does it mean basically bringing more money? What do I mean by this? When you sell options, the premium that you're going to receive when you sell that option basically defines how much money you're going to make. And let me give you an example so it's clear. Let's say that you want to sell a put option on United States Steel Corporation from the ticker X. So if we go for example into the option chain, and let's say for the sake of the example, I'm not going to go too far in the explanations, which expiration, whatever. Let's just take a random option. So let's go into the August expiration. Let's say that I sell the 21 put, and by selling the 21 put, I would receive $1.10 of credits, meaning that my max profit, as you can see, is of $110, because when you sell options, the premium that you receive is your max profit, compared to when you buy option, the cost of the option is the premium that you pay. So basically the buyer of the option pays the premium and the option seller receives the premium. And especially for people who like to sell options like myself, when you sell options, the premium that you're receiving dictates how much money you're going to make. So based on that thinking, the bigger the premium, the more money you're going to make, basically, because I said that the premium dictates how much money you're going to make. You see that I receive $1.10 here selling that 21 put option on X, and I would make $110 max profit, meaning that really it's the premium that dictates how much money you're going to make when you sell options. So now you might understand why they are actually quite profitable, because basically what that means, if the bigger the premium, the more money you're going to make as an option seller, then ideally you want to focus on stocks that have quite big premiums when you sell options, so you basically make more money. So far so good, right? And that's exactly what is happening with all those 6 stocks. Those 6 stocks that you can see in that watch list are basically having quite expensive premiums overall at any given time, meaning that if you sell options on those stocks, then you're going to make a lot more money compared to normal stocks, I mean random stocks. Hence why I like to focus especially on those 6 stocks that you can see on the screen right now, because they tend to make me a lot more money. So why would I go trade other stocks that tend to make me less money if I can just trade stocks that have the same risk and that brings me more money? So in the end, I might as well trade those highly profitable stocks that I just talked to you about. So now you might wonder, why are those stocks actually more profitable than others? I get that I receive more premium for those stocks in particular compared to some others, but why is it the case? Well, to understand why, some premiums are bigger than others for some stocks, we need to understand how is an option priced. We all know that, what comes into an option price, there is the stock, meaning that if the stock moves, then the option prices are going to move. This, we agree on that. However, there is not only the stock that goes within the option pricing. There's also something else. I'm sure that you've noticed that, for example, you bought a call option, the stock went up, and still you lost money. Why? Well, the reason why is because of the implied volatility. And the implied volatility basically refers to the volatility that people are thinking that the stock is going to have. And that volatility, that assumption, is going to be shown in the option premium. And let me give you an example because I know that it might not be clear. If I show you, for example, AMC, so you see that this is the AMC chart. So you can see that since last year, AMC has been, let's say, on a wild ride. So if I ask you, where do you think AMC will be in a year? I'm sure that some of you might think that AMC will probably go to $100 per share, 200, or maybe will fall to $10 per share. But I'm sure that everyone who's watching this video will pretty much have different opinions, but quite wild different opinions, meaning that some will think that the stock is going to triple, maybe some think that the stock will crash by 90%, but overall, we all think that the stock is going to move a lot during the next year. And because of that, because we all think that the stock is going to move a lot, it's going to influence the option prices. Because now we all agree that basically something is going to happen. There's going to be a lot of volatility. And that basically is called the implied volatility, because we imply a certain volatility for a certain stock, like AMC in our example. So meaning that if you think that AMC, let's say, has a very good potential of moving a lot over the next year, compared to a stock that has very little potential of moving over the next year, then AMC, in our case, is going to have much more expensive options because we expect a lot more. And when there is a lot of volatility, options tend to become more expensive. And on the opposite, the less we expect from a stock, the cheaper the options, and so the lower the implied volatility. So you can understand that there is not only, the stock that is going to go into the option price, there is also what people think about that stock. There is this implied volatility. What are people thinking about those stocks? And that will dictate how expensive or how cheap option prices are. It's just to tell you basically that there is this volatility that goes into the option pricing. But how does that help us? Well, if we know that, based on the implied volatility, premiums are going to get more or less expensive, then in that case, if we focus, for example, on the stocks that have the highest implied volatility, well, in that case, we know that we're going to have quite expensive options, because remember, I said that the higher the volatility, the more expensive the options are going to be. So for example, if we go into my watch list, so this is a watch list of around 40 stocks, and they are quite liquid overall. This is a watch list that I shared in previous videos. And by the way, if you want to have the link of that watch list and you like to know all of the tickers in that watch list, I'll put a link in the description of the video, so don't hesitate to check it out. So if we look at that watch list, and for example, you can see that there is this thing, IVX, that's for implied volatility index. If we, for example, filter it to, let's say, having the stocks with the biggest implied volatility first, well, we're going to see that basically the higher the implied volatility, the more expensive the options are going to be overall. For example, let's compare X, the stock that we looked at earlier, compared to the one with the lowest implied volatility, like, let's say, EWG, so the ETF that tracks the German index. We're going to compare two options that are very close out the money together on those two different stocks, and you're going to see how different they are in premium and basically what the implied volatility does on options. If we're about to sell the 22 put on United States Steel Corporation, we would collect $1.54 of premium. So that's the premium for the first put at the money strike for the stock ticker X. Then now, if we go into EWG and we look at the closest at the money strike for the same expiration, we are going to sell a put collecting a credit of 60 cents. So you see that there is a massive difference between $1.54 and 60 cents on the other hand for EWG. And if you remember what I said before, I said that if you are an option seller, you like to sell options, then how much premium you're going to receive is basically going to dictate how much money you're going to make. So if we base ourselves on that, then you really want to sell, for example, an option on X rather than EWG. And the reason is you're going to make a lot more money if you sell a put option on X compared to EWG. And of course, there are other factors to take into account, like do you even want to trade the stocks? But my point is just just to show you how wild the difference can be between two stocks that are around the same price but have very different implied volatilities. So by going to those very high implied volatility stocks, you are usually going to find more expensive premiums. So if you like to sell options like myself, personally, I like to go for stocks that have quite high implied volatility overall, because at least I'm going to make more money for the risk that I'm taking. And I'd rather make more money for the same risk that I'm taking, but that's my opinion. After that, I want to make also a disclaimer, because I don't want to, like just push you to go for the highest implied volatility stocks and just, start selling options for the sake of selling options on high implied volatility stocks. I really want to emphasize the fact that, when you sell options, you might as well go for higher implied volatility stocks overall, because they are going to bring you more premium, which means more money for you when you sell options. And that's something that, really helped me personally, because when I looked at, for example, my trading statements and I looked at which stocks were bringing me the most money, you could directly see a correlation between the implied volatility of the stock and how much money I was making for that stock. And basically what I found is that the stocks with the highest implied volatility were bringing me the most money, and I started wondering, why do I bother trading stocks that have low implied volatilities where I almost don't make money and I also take risks? I might as well go trade those high implied volatility stocks that, yes, I might also have risk, but I'm also having risk on low implied volatility stocks anyway. So I might as well go for stocks that are going to pay me more. So that was basically my thinking, and that's what also pushed me to create that list of 6 stocks that you can see on the screen right now. That basically is the list of the 6 most profitable stocks so far, for at least for the year 2021. After that, once you've selected, let's say 4, 5, 6 stocks like myself, where you selected some high implied volatility stocks, you can always look at, let's say, for example, the IV percentile, so as to complement your strategy. And let me explain that if that's not clear. The IV percentile is basically a percentage that is going to help you put in perspective how high or how low is the implied volatility of the stock that you're looking at based on what happened in the past 12 months. So let me clarify that, because I know that sounds very complicated, but trust me, it's not. Let's say, once again, we're going to take United States Steel Corporation as an example, because I like this stock and I want to take it as an example for the whole video. Let's say that usually X has an implied volatility of, let's say, around 60%. If over the whole year it has an implied volatility of 60%, and then the implied volatility jumps, let's say, to 120%, well, in that case, relatively speaking, based on what happened before for that particular stock, 120% is actually quite high. So if you sell options on a stock that has a high implied volatility percentile, you're basically betting that the volatility is relatively high for that particular stock. And that's personally something that I like to focus on top of that. Meaning that I'm going to go for those 6 stocks, for example, that you can see, where I know that they have good premiums. And then after that, I'm going to look at which stocks has the highest IV percentile. So I know that I'm going to sell quite expensive options relative to what happened in the past for that particular stock. So the IV percentile basically puts things in perspective for the stock that you're looking at, and that's very useful. For example, CLF right now has an implied volatility percentile of 60%. It means that over the past year, 60% of the time, options on CLF were cheaper than what they are now. Meaning that right now they are pretty expensive. 60% of the time they were cheaper than this. And if it jumps, let's say, to 80% IV percentile, it means that 80% of the time over the past year, options were cheaper compared to what they are now, meaning that now they're pretty expensive. So that's a good way of knowing basically what is too expensive or what is too cheap. That helps you put in perspective what is, overpriced or underpriced, and that's very useful. I hope it made sense. I know I've gone on a rant, but I still hope it's clear. And really, if you have any questions, just don't hesitate to put it below. I'll be happy to answer any question that you might have. If you'd like to have those 6 stocks, well, you can just either, take a screenshot of those stocks. Otherwise, I'll put a link in the description of that video. So if you want to download that watch list of 6 stocks, I hope it brought you value. And if you like to sell options, maybe it helps you know why on some stocks you're making more money than some others, and what basically you need to look at when you're trying to sell options. As I said, if you have any questions, just comment them below and I'll be happy to answer any question that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.